Welcome to CRE Unplugged, the Founder Series, where we spotlight the founders who are reimagining the built world. With me today are Alix Maurin and Joseph Thalinjan, co-founders of RentFlow, a platform that is revolutionizing how commercial tenants manage rent payments, helping businesses move beyond the rigid constraints of traditional monthly rent cycles and more toward flexible, cash flow aligned payment solutions. Both Y Combinator alumni and former McKinsey consultants, Alix and Joseph bring expertise in fintech strategy and commercial real estate operations to their mission of creating financial flexibility for small businesses. Today's conversation will explore their entrepreneurial journey from management consulting to founding RentFlow, how innovative payment solutions can drive rent outcomes to both tenants and landlords, and why flexible rent payments play a critical role in helping small businesses thrive and sustaining healthier commercial real estate portfolios. And with that, I would like to introduce Alix Maurin and Joseph Thalinjan. Thank you so much for joining us today.
Thank you so much for having us. We're really glad.
Thank you, Ryan.
I have to say, as startup founders, how much sleep are you guys getting on a daily basis?
I mean, just look at our eyes. They're very tiny. So yeah, no comment. I think 4 hours is good enough, honestly.
Are you both early birds or night owls when it comes to your work?
Yeah, we're more night owls. We like to work late in the night. Everything is silent and you can just crunch your work.
But it's terrible, and I wish I were an early bird, honestly. It sounds much more inspiring.
I have to resonate with you, Alix, because I've always wanted to be an early bird. I've always been a night owl, throughout college, throughout my entire 20s and 30s. I've just not been able to wake up early in the morning. It's like something that you try to do, but your body is always telling you, no, it's not going to happen today.
Yeah.
But I'm sure with your late hours, it's even tougher to try to get up early and be productive.
It's pretty much going to sleep late and then getting up early because you don't have a choice. So we're kind of not getting any side of the deal for now.
Well, I hope you guys get more sleep because it is important at the end of the day. Well, I want to dive into what you were doing before RentFlow, and what was that aha moment when you saw this gap between small businesses and financial. Sorry, let's redo that. Sorry about that.
No worries.
Okay.
That'll help me cough a little bit.
Yeah, okay. All right. I want to know what you both were doing before RentFlow, and what was that aha moment that you saw a gap between businesses' needs and the financial tools that are offered. Walk us through Y Combinator and the decision to pivot, and why did you zero in on rent and cash flow?
Yeah, a lot of things to unpack. So before RentFlow, before any of this started, we were both consultants at McKinsey, both specialized in financial services and real estate. And even at that point, you could kind of see the gap between what banks and fintechs were offering small business owners versus their day-to-day problem and just flying blind on cash flow and just needing somebody to take that off their shoulders versus what they were getting from banks. You could kind of already see the gap. And so, yeah, that was the first step. Then after about nearly 3 years of consulting, we applied to Y Combinator and got in. And we can definitely follow up by telling you all about that experience because that was amazing and changed a lot of things for us. And during Y Combinator, we actually were working on a different idea, very different. And so we entered into the traditional pivot hell that some YC companies go through before landing on their idea that they really want to work on. So we were working on an idea for a market that was a little bit too small and very conservative, much more conservative than the real estate market. And it was just an uphill battle, even though the technology was great. So we decided to cut our losses early and look for other things, other ideas, and just go back to our roots within financial services and real estate and just look into the market. And kind of at first it was a bit of a broad search. And then basically the aha moment was so we're consultants, so we're pretty data driven. And so obviously the aha moment was finding a piece of data. And then we stopped there, we were shocked, and we were just like, okay, we just need to dig into this problem because it's too big to be ignored, and it looks like it is ignored. So essentially, when you look at the surveys and stats out there, very large scale stats across the US, you see that nearly 50% of small and mid-sized business owners declare that they are late on rent on a single month, essentially struggling on rent or even in rent delinquency. So on any given month, each time the survey is renewed on a monthly basis, you've got that response, and those numbers are just creeping up. It's pretty alarming. It came from a very trustworthy source, which is Alignable. They're a major business association with 9 million members across the US, and so that really felt massive and underexplored. So then we went deeper into that, and we talked directly to business owners around us at the time in San Francisco. We really pestered them. We cold called and cold emailed landlords and property managers, and ended up, after a lot of persistence, to getting some discussions. And just what we learned is that, first of all, this is a terrible cycle for both property managers, of course, and business owners. Property managers spend a lot of time, money, and effort just chasing late rent from their commercial tenants each month. It can take 2 weeks or more just chasing these guys. It really impacts property cash flow stability as well when you receive your rent late, and it can even end up into vicious cycles of lease break and vacancy, and just it's not a good situation. And for business owners, it's also a pretty painful situation because they rake up late fees, which are pretty expensive each month, especially for businesses. And then obviously it increases the cash flow stress, instability, overdraft fees, predatory loans that they may take to try to stop the situation. And it just creates repeated cycles of cash flow stress. So to make a long story short, we understood that this was a cycle of compounding costs on both sides of the lease. And we explored the market and found that there were no financial services to kind of get in between these two counterparties and break that issue up and solve it. So we decided that that was our mission.
It's interesting because I don't think most people know how widespread rent payment struggles are for small businesses. And I think you can kind of share what really the landscape looks like and how has it changed since COVID?
Yes, definitely. I agree. Rent stress among business owners and small business owners is pretty often overlooked and mostly managed by collections teams and the business owner themselves. But it's very widespread. And when you look at the stats, about 4 in 10 business owners, and it even reaches 5 in 10 at different times of the year, are just declaring that rent delinquency is one of their major issues of the month. And so when we spoke to landlords and business owners and also underwrote our own current users, we found different reasons behind this, and especially the COVID situation. The first reason we found is simply that there is a structural cash flow mismatch between fixed rent payment schedules that businesses often operate on versus how their cash actually comes into their business. So to give you a few quick examples, for example, we have a lot of medical clinics on our platform, and these guys often get reimbursed 30 to 90 days after consultation by insurance payouts. And so even busy practices can get cash constrained when rent, as well as high payroll with the nursing staff, etc., are pretty much due on the same date. And they're just waiting on their insurance payouts timings don't align, and then they get stuck. Same thing for retail, has a lot of seasonality here. Restaurants, construction businesses, you always have somebody waiting on a client payout and having to pay rent late, etc. You always have one-offs or structural problems that occur. So yeah, that's the whole timing mismatch aspect. And second, we have the COVID and post-COVID environment, which is really problematic. So since COVID, essentially costs have reset higher for small business owners and pretty much stayed there. Business owners cite labor costs as a top challenge, as well as non-labor inputs. So, for example, food for restaurants, raw materials and tariffs for retailers. You've got all these factors that are just kind of compounding and putting additional financial stress on business owners who don't necessarily have the time or resources to manage all of that. And at the same time, foot traffic, demand, etc., have not really normalized evenly, especially for office adjacent retail, restaurants, things like that. Things have not gone back to normal very quickly. Rents have also increased. So after COVID concessions kind of settled down, a lot of businesses actually ended up with higher rents versus pre-COVID levels, especially in a lot of retail and mixed-use buildings. Right as revenue was still a bit uneven, so it really kind of entrenched bad payment habits at that time. On top of that, a lot of businesses are still carrying emergency debt from the COVID era, so obviously additional costs per month. And so with all of these compounding issues, you've also got the fact that during COVID, a lot of landlords, to try to end up with less vacancies, gave a lot of concessions and flexibility on rent payment to small businesses. So they kind of took the habit of paying in smaller pieces or paying later, and that being seen as okay. And after COVID, with all these problems I mentioned, those late payment habits sort of became more normal and more widespread. And so before COVID, late rent was at around 20 to 30% for the commercial sector for small businesses. And then it just jumped up to over 40% post-COVID, and it's just been creeping up, unfortunately. And the last reason that we see that is really just making all of these issues worse is that most small operators are stuck in reactive mode when it comes to cash and financial management and not proactive. So when you look at the stats, first of all, around 90% of business owners cite cash flow fluctuation as a major stressor, but only 30% say that they're willing to actively manage it and are making efforts towards that. Because essentially a business owner is extremely busy, doesn't necessarily have the resource or knowledge to manage the cash flow like a big company would. And so essentially, what landlords tell us is that they're always calling them up, for example, after late fees hit rather than before. They're not proactively managing things. We are partnering with a large fintech that lends to restaurants, and the CEO told us, yeah, that's the problem even with the biggest restaurants. And he owns restaurants, and at the end he had to manually go in and put aside money each day for rent at the place of the restaurant owner, simply because they were not at all proactive about that. And every dime that came into the business was spent immediately on not necessarily very useful things. And at the end of the month, even if they had a good month, they're still feeling very squeezed with rent. So this mismanagement or lack of very structured management is just compounding the effects of the environment.
I think all the points that you've raised, I've dealt with in my previous role. We had a portfolio of office and retail tenants, and during COVID, we were handing out a lot of relief to a lot of our tenants because they couldn't pay their rent on time. So we had to come up with a lot of different strategies to provide them with concessions or provide them with payment plans in order for them to pay this rent. But you think, as you said, you think that then they would be able to stop the late payments once things have settled down, but that wasn't the case. And there were a lot of restaurateurs, as you also mentioned, that were having these problems. But what I find very interesting, and I don't think our audience members would probably be shocked to hear about the medical tenants and the medical offices who are having that trouble because they need to get that payment from the insurance companies. So I find that very intriguing and for me, very surprising too. one thing I would want to, hear you guys talk about is, a lot of founders have a tough time with product market fit. And it seems to me that you both did the research and you both did a lot of data analysis to say to yourselves, I think we're onto something. So can you elaborate more on that?
Yeah, definitely. Um, just to clarify, do you mean in terms of the market research we did, or in terms of finding our correct product market fit and seeing the results and saying, okay, we're onto something?
Yeah, I think the latter would be great to hear.
Yeah, definitely. Essentially, we definitely had the hunch that there was a problem. We saw the statistics of the results of the issue, which is, nearly half of business owners not paying on time. And we spoke to a lot of different businesses and kind of understood that the problem was universal, whatever sector you looked into. As you say, medical clinics are sort of surprising, but you look at behind the scenes, a lot of businesses that are established and not necessarily in very fragile sounding industries actually do have all of them the same problem. So we were pretty convinced at that point. And we just launched our platform, our rent splitting platform, abruptly in last May. And this was pretty much the make or break test where we were just thinking, what's going to be the result here? Do people need it? From our conversations, people needed it, but are people going to sign up, etc.? So we started out doing direct signups from business owners. We built the initial version of our platform, launched ads on Facebook and Instagram, and we were very surprised because we were flooded by signups from the beginning. We put out very tempting ads like "pay your rent later," "cash comes in before," etc., and had extremely high click-through rates. Our click-through rates were 7 times the average rate that you see in the fintech industry. So we were pretty surprised at first, and it was a bit of too much of an influx for us to manage at the beginning. And what we understood is that any type of business was signing up. So you had very high rent warehouses who were just like, this is a horrible part of my budget. I just need it smoothed out. We had seasonal businesses, for example, even car repair businesses who did way better in the winter than in the summer because cars break down in the winter. They're just like, help me for the summer months. We had restaurants, retail, co-working offices where, for example, accountants or tax businesses were just waiting. Like it was pretty much a project or client payment based timing that didn't line up with rent. So we kind of saw timing and structural cash flow issues in any type of industry. And we saw a lot of diverse tenants signing up with diverse rent amounts. And the feedback that we got from these tenants, because we called them up and we stayed close to them, and they also knew that they had a direct line to us, so they were calling us as well. And the feedback that we had was very interesting and helped us really refine the product market fit, which is basically half of our users didn't really need us to pay rent on time. They were already okay. But what they were telling us is that this really helped them smooth out their cash flow situation. And for example, for medical clinics, typically we have somebody who's very, very well off, but they are using our product because when nursing payroll hits their account on the same day as rent, and both are very high costs, they can have overdraft fees and can have huge cash yo-yos, even though during the month they're doing very well. So they just want to smooth that out and get rent out of the way because they're very busy and we just manage it for them. The other 50% is the really interesting piece of the feedback, and where we really found the product market fit is basically people who are, cyclical cash flow businesses, payment mismatch, or just simply high rent and tight margins and low cash buffer, like a lot of businesses. And we're just routinely paying rent late. And we just changed that around. And the feedback that we had is you changed the way we run our business. Some people even, told us that this was the first time that they had budgeted anything. And this was great because they weren't lifting a finger to budget it and they were just forgetting about rent. That's a lot of the feedback we had is I can forget about rent now. And some someone actually recently was expanding her business and essentially signing a lease for a second location, a second store. And she made her landlord wait to sign the lease because she wanted to make sure first that it was eligible on RentFlow. So we really understood that this was a vital month-to-month service to just break your rent up into payment plans. And that's how we validated the product market fit. And then when we understood that the landlords of our users were actually also pretty happy with the service because we just kept calling them and asking them for feedback. And they were just like, oh, I had tenants paying me late and now they're paying me on time. So I like you guys. It was pretty simple value prop there. So we understood that the fit was essentially very vital for the tenants and also a very nice bonus for the landlords. And that's why we kept digging in that direction.
I think it's great when you're talking about how tenants weren't really focusing on paying their rent on time, but then by using your platform, now they are thinking about rent. And that's like music to landlords' ears, right? They're like, okay, we've got tenants who are now focusing on paying their rent on time. What a
Yeah.
concept. And then at the same time, you're also hearing how tenants are trying to expand and they want to make sure that they can expand, but only if rent flow is applicable for their business. So I think it's such a win-win for not only the landlords, but also for the tenants. So that's really great to hear. You're both ex consultants, as you mentioned earlier, and you take a very data-driven approach to understanding cash flow and payment behavior. So, how does better data change the game for businesses and their landlords? What patterns are you seeing in the data that landlords and traditional credit checks completely miss?
Yeah, so we have to think about we have to differentiate the consumer side and the business side. Usually what happens is that on the consumer side, people tend to just pull the credit report, either a soft pull or a hard pull, and then they make a decision based on the FICO score, basically. And this has been happening like over the past decades, basically. And we know today that it just doesn't work. The FICO doesn't give any information on the lender. It just predicts the past, but doesn't. It's a snapshot of the past, but doesn't predict the future. And on the business side, what people have tried to do is really try to do some cash flow analysis, but stay really low at like what is the revenue growth, what are the expense growth, and is the company viable? But they don't know, for example, if the revenue is real revenue or is it just money injection. They don't know if the expense is for the business to generate revenue or if it's just like a personal expense, basically. So these are the insights that we're missing until today. And there has been basically no tool to do that. Some banks tried in the past to go line by line in the transaction and ask the merchant, what is this line? Why did you do that? Why did you expense that, etc. So it basically takes a 10 people job for a week to just underwrite the person. So what happens is that after spending 1 week, basically the approval rate decreases and they need to make at least $15,000 or $20,000 loan to break even that underwriting cost. So it was impossible to do like $1,000 loan for a business and be viable. So when we saw that issue and we saw that many companies in the field basically failed because of that high underwriting cost, we realized that we need to do a data-driven approach. And our thesis was every information on the business relies on the bank statements and on the bank transaction data. So what we try to do is that we kept that original cash flow analysis with all the ratio we know, the revenue, growth, expenses, etc. But then we added on top the behavior analysis of the business owner. Because we are talking about small businesses, so small businesses tend to behave like consumers, and small businesses tend to behave like their business owner. So when you analyze the business owner, you basically analyze the business itself. And what we try to do, and with the development of AI and everything, and with the use of LLMs, we try to basically predict what does the person do when times are tough. Is this person going after a new loan? Is this person trying to generate revenue? Is this person trying to reduce expenses? Or on the other end, is this person spending on unnecessary things when the balances are really hitting the near zero? So this is the type of insights that we can get today pretty much instantly and try to get a view of what's the behavioral analysis of this owner, and then we combine that with the traditional analysis, and then we can get the insights of do we approve this person or not, and basically predict how this person is going to perform on our platform. And we think by having this dual approach, we can approve much more people and reduce the risk at the same time.
Yeah, and on top of the behavioral aspect, which is extremely key, as Joseph said, you can have a business that looks good on the surface, but if you're going to follow somebody year long and support them on their rent payments, but their behavior is not appropriate, you're going to run into issues, and credit scores, etc., don't necessarily reflect all of those little micro daily habits that really compound. And on top of that, the data really helps us to change rent to, can this tenant pay? Essentially, that's the question that landlords were asking, like, can this tenant pay rent? To when can this business actually pay rent? Which is something that you can just modulate year long to make sure that the yearly rent is paid, just not necessarily at the dates that are fixed, essentially. So a lot of traditional credit checks, etc., don't do that. They're pretty much backward looking, and they treat late rent as a failure, when essentially you can just recalibrate and say, wait, is this not a timing issue? So for example, retail businesses have real seasonal fluctuations. So at the end of the holidays, they just, consumers just had a peak of buying spree, but now they're done with buying and they're back home. At the same time, retailers have bought a lot of inventory that's just sitting there, and they're just waiting for habits to pick back up. And if you catch them off guard in January or February, they're going to feel very squeezed on rent. So anyway, that's just an example. So when you look at the cash flow structure and when a business can pay during the year, it changes the data a lot, and it can change bad payers to good payers if you modulate the dates. And if you compound that with what Joseph was describing, which is behavioral tendencies and micro habits, you can really see if a business is risky beyond just industry, geography, past history. You can see if the business owner's habits are risky, or if they're actually going to work with you to pay rent on the better timings for them. So it really helps us to get a much better snapshot of how a business would act on our payment plan.
But you're also helping to do a lot of the dirty work for these landlords. Like you're doing all this analysis using AI, figuring out behavioral patterns and their tendencies. That's stuff that landlords don't even want to touch. So the fact that you're doing that, you're taking a lot of their work away, and you're giving them a lot of solace into knowing that, hey, my tenant is using RentFlow. I know that I will get the rent no matter what each month. It may not be on the first of the month, but at least I know that they're being backed by a service that I can trust, which is you.
Yeah. Yes. So just to also clarify that, so landlords are paid on the first of the month. Because we know that they're
Sorry.
No, not at all, at all. It's good because then it helps us to clarify how that all works. Basically we know that landlords and property groups need stable cash flow, and that there's a big metric around the percent of rent that is collected on the first of the month, and we want to help landlords reach that metric and just have all of their rent in on the first. So what we do is that we get into the middle of landlords and business owners. On our side, we pay landlords on behalf of the business owner on the first of the month at no cost to them. We just, instead of being paid by their tenant, they're just paid by us. That's all that changes. And on the business tenant side, that's where we open up the repayment plans to us, which can be weekly auto payments, daily micro pools of sales. It can be really different based on the risk level and cash flow level of these companies. And so that really just essentially makes timing fluid for landlords and doesn't change their first of the month habits. And it makes timing way more flexible for business tenants year long. And so what you were saying of, getting into those insights and kind of doing the dirty work for landlords, that's definitely something that we want to capitalize on. So essentially, it really, for us, acts as an incentive for landlords to work with us beyond just the payment benefits. Because since we are connected to all of the business accounts and payment gateways of their tenants 24/7 throughout the year, and we're providing a vital service for their tenants, we're just able to get all of that information and get all of the sales information, and we're processing it and analyzing tenant behavior signals, etc. And we're able to package that in a more aggregated, less intrusive format, and share that to landlords so that they have more proactive insights into their portfolio and their business tenant performance and sales risks, etc. And we're doing this because we had conversations with some of the biggest commercial property groups and REITs out there. And the main thing that came up was I'm flying blind on my tenants' sales levels. And some of them tell me that they are having horrible sales performances. And so I'm keeping my rents below market level for the past 2 years. But actually, I find out that they're doing very well, but I had no way of knowing. Or on the opposite side, my tenants, I feel, are getting risky, but they don't want to share anything with me. So I don't know if I'm going to end up with a lease break in the next 6 months because I have no clue what their sales are. So we're able to kind of get out there some proactive signals that can help adjust rent levels and kind of anticipate problems before they escalate, basically, because we are able to access that sales data with the kind of unrefusable carrot of rent flexibility that we offer tenants. So that is kind of the unlock for that sales data to become more fluid and for us to be able to extract some actionable insights.
Yeah, thank you for the clarification.
Yeah, of course.
Yeah, and I think what is happening is you're solving this major problem, which is rent payments. But I want to talk about, like, where are you headed next? Like, where does this go beyond rent payments? What vision looks like in 5 years if everything goes right? Are you still focused on rent, or is this going to expand into broader, like, small business infrastructure?
Yeah, that's a really good question. So basically, the first branch is going to be to double down on business rent, simply because we see that the ecosystem is too interesting. We see that there are a lot of potential partners for us beyond landlords, for instance. So we're integrating with one of the largest rent payment portals at the moment to just present RentFlow as an embedded payment option. And we are also partnering and doing a live pilot with a major SME lending fintech. So we really just want to act as a sort of stability layer for SMEs across the partner ecosystem. And that's, I think, what's going to carry us to the next phase, which is just doubling down as a service lender for businesses. So what we really saw is when businesses sign up on RentFlow, we see their cash flow becomes a bit smoother over time. We see they have less nasty overdraft fees. We even see some people start to take less predatory cash advances, etc. And we kind of see that we are sparing them some difficulties that they run down the line with because they are in very reactive mode, and we're kind of switching that around. And so we want to keep doing that and keep being a lender that's also kind of a budget tool and service provider. And what we see is that tenants and so our users keep on calling us and asking us, hey, do you do this for other fixed costs? Can you do this for my payroll? So I know we're talking about medical clinics all the time, but these guys are very active to give us feedback. And so we get a lot of feedback from people telling us, I need to pay my nurses on a daily flexible basis because these fixed costs are killing me. And we are thinking down the line of, first of all, strengthening the rent aspect a lot because that's a huge pain point, but potentially bundling it up with other types of fixed costs that essentially don't, like rent, don't at all act the way that cash comes into the business, and just realigning the way that fixed costs go out of the business and turn them into variable costs, just like revenue is variable. And so the demand from users for this type of service has been very strong. And I think that's essentially where we want to go. And we want to really turn businesses into proactive cash managers rather than just permanent panic mode. And we see that with the insights that we gather, with the data that we gather, we can give out a lot of kind of AI CFO type insights to business owners and just give them back the data that they share with us in a very essentially like oriented mode and saying, hey, you need to limit your personal expenses X days before payroll goes out because that's your problem that's bringing you to overdraft after payroll clears, or different types of advices like that, and just build a sort of AI CFO that not only gives advice but actually acts on it for you and budgets your fixed costs for you and manages the way your cash goes out of your account, so that it really just manages your business for you and you can stay focused on what interests you, being a cook, being a doctor, whatever interests you, not being on top of that, a CFO in panic mode.
Yeah, I mean, that's what everyone's talking about, right? With AI is you get to focus on your strengths, you get to focus on what you want to do, and you're leaving a lot of the, let's say, administrative, or in this case, CFO type of duties to your platform. Or
Yes.
and I think that's something that's really incredible. Uh, one thing I love to talk about is, I think your platform is really successful. Things are going great, but every founder or founders have moments when progress slows and you've got that doubt creeping in. So, can you share a time where you questioned the path you were on? What actually keeps you going when the way forward isn't obvious?
Yeah. I can definitely take the question. So what sort of slowed us down at first is that when you're fresh out of YC, for example, you see a lot of companies who have great beginnings because they're essentially, for example, developer tools, sales tooling, etc., or urgent compliance tools such as SOC 2 compliance, which is big problem and everybody's very willing to try new solutions. And so they're just companies who are selling new tools to other companies that are behaving like startups and that are very reactive and looking for innovation and change. And so we kind of had that image in mind. And then when we switched to building in the real estate industry, we found people who are not in that mode of like perpetually looking for new things and actually being happy if it's a very small and new company because that means it's going to be a different tech. It's pretty much the opposite here. It's a bit more of a conservative industry, and what matters a lot is are you already a big brand name? Do you work with people I know, etc. And so it was a bit discouraging when we started reaching out to real estate groups, and we had whole cold email and cold phone call system, and we had answers like, this sounds too good to be true, so it must be a scam. Or people replying stop in all caps, or very paper-based landlords, smaller landlords saying, oh, but this is going to be a costly tech integration, and not even stopping long enough to understand that there was no tech integration associated. And so, the reality was pretty simple. People were very busy and did not really want somebody they didn't know to come in and tell them to change their ways, which, I get. And so that was a bit of a chicken and egg situation that kind of stressed us out at the beginning, because we were like, okay, so we need partners to get credibility, but we need credibility to get partners. And so that really just put us in a little bit of a funk for a while. But there were two factors that really pulled us out of there. The first factor was just launching our platform anyway and seeing the traction from business owners and the traction from companies outside of real estate groups, such as fintechs and property management software, and just seeing that when you sign up a business owner who this is very urgent, then traction is there. So it just confirmed what we were thinking, and it gave us some momentum, and it really kept us going. And we had sometimes tenants call us some weeks saying, "Bless you, you changed things," which is really cute. And so it really just kept us going. And the second thing is that since we were boosted by this initial proof of concept and an initial activity, we just kept pushing on the real estate side relentlessly. And we started to see results. So after basically an enormous amount of cold outreach on our end, I think we were pests basically, but it ended up working. We ended up having some discussions with landlords and with big groups, especially when some of their users were already on our platform. That was a bit of an icebreaker. And then we could really confirm what we wanted to confirm, which was, yes, this is a terrible problem for them. The thing that they also want are essentially sales signals from their tenants, which is what we're doing right now. And it's thanks to those conversations that we really dug into. We need to aggregate data and give it back to the landlords. So that really got us out of the doubt phase as well, just persevering on that side and unlocking some conversations. And very importantly, we saw that the real estate industry does have structures that promote innovation and that understand also the pain of getting into an industry where there are already very large players and that can help very newcomers. So, for example, we are incubated by CRE, that's managed by Ashkan Zandier, and he essentially knows firsthand the go-to-market and distribution challenges in real estate. And he built a structure that connects you with real estate groups and property owners that want to pilot new solutions. And so we're essentially just pitching directly to people who are open to it, which is really a game changer because early adopters do exist. But if you're all alone trying to find them in an ocean of people who will reply stop to your emails, it's very disheartening. So this is really a huge accelerator for us. So that's the last, but I think one of the most important factors that got us out of the disheartening phase.
Ashkan is a good friend of mine, and I think what he's doing with the CRE Foundation is great. And having you as in the first cohort really is going to be a game changer for the both of you in achieving that success because I know he has the contacts and he has the know-how into helping you both move forward. So it makes me proud that a friend of mine have been able to connect with him and help grow your company. What would you tell someone who is just thinking about, hey, I'm working a corporate job. I want to get myself into maybe starting a new company or a startup. What advice would you give to that person? And also, what would you wish you may have told someone before you started RentFlow?
Yeah. I think both of us can give our perspectives on this one. Do you want to start?
Yeah, you can start.
I can start? Okay. So essentially what I wish somebody had told me, I think, before launching this is that we see all of these amazing success stories from entrepreneurs, but the important thing is that building a startup at the beginning is not necessarily about having confidence from day one. It's actually about learning to operate every day without it, especially at first, and learning to, operate with doubt. Essentially, you will never be sure that you're on the right idea, but you need to keep going at first. And doubt doesn't disappear once you find product market fit. It just evolves and new questions pop up and new doubts pop up. And you just have to get clarity after you take action and not before, which is, I think, the opposite of what a big group does. Usually big groups try to get clarity before acting on a situation and understanding beforehand what they want to do. Here, it's more, I need to act, and if it doesn't give me the result I want, then I need to act differently. But I will always get that clarity after I act. So learning to deal with the blind spots and with the doubt every day and operate in spite of it is, I think, a big strength to have, and that we had to build. We didn't have it at first. And to someone debating whether to leave a stable job and at a big company and kind of do what we did, I would say don't necessarily wait until you have a perfect idea and you have a perfect proof before doing it, or else you'll just be waiting forever. Because, yeah, again, clarity kind of follows action, not the other way around. And don't leave for the fantasy of like a perfect outcome and a perfect success story. Don't leave for like, I'm going to make it and then retire, because then that will not carry you through the moments of like messiness and doubt and unclearness, etc. Just leave if the problem that you essentially leave before you have a solution, but at the point where you have a problem that you just want to solve and are very obstinate about solving, because that will help you through the messy phases at first. And that will carry you, I think, much farther than just having a dream of having made it and not thinking about what comes in between, basically. And one thing that our YC partners told us, especially at the end of the batch, they just told that to all of the companies, is just don't die. And so that sounded kind of as a last piece of advice, but it's actually the most important advice, which is you can't rely on shiny rewards when things don't get exciting. You just need to power through it and not die, and just be excited by slow progress and things that appear to unlock before anybody else sees this from the outside, and just keep going that way, I would say. I don't know if I think we pretty much had the same conclusions on that.
Yeah, I would say, especially with all the tools that are out there today, it's so fast to build and to try and to test and to fail and retry that it doesn't make sense today to wait. You can just code yourself and try the market, and especially with the social media and everything, you can spread your product out there on the consumer space at least, and really get an answer quickly on does that work or does that not work.
Yeah.
And you can also build with really lean and small teams. So you just need a couple of friends to try to launch a company and really scale it without even needing to hire or to raise money and everything. So I think it's really a good opportunity today to build something.
I 100% agree with you. I think with the world of AI, it's pretty incredible how you could bootstrap a company with just, as you said, a couple of friends. And Alix, when you were talking about Y Combinator, I was thinking about Zach Aarons, who I've done some panels with in the past. He's the founder at Metaprop, and he talks about don't get into real estate tech. Whatever you do, don't. But if you have to, it really has to be a problem that you really want to solve. And it seems that with you, Alix and Joseph, you are solving a problem that you're passionate about. And from the feedback you're getting from your clients, it seems that it is a big problem. And I'm glad that the two of you are solving it.
Thank you so much.
Thank you, Ryan.
Yeah, I'm so glad to have you both on. I know you're both from France. I took seventh grade French and then didn't continue on, but maybe next time when we get on the pod, you could help me with a few words. But I will say merci, uh, right? And I wish you all the success with your company. And yeah, thank you so much for joining us.
Well, thank you for having us, and merci to you too.
Yeah, thank you so much. That was great.
All right, be sure to stay tuned for my recap. Listening to Alix and Joseph today really took me back at a time when I was working at Empire. We had office and retail tenants constantly struggling with rent payments, not because they were bad businesses, but because their cash flow just didn't align with the rigid first of the month deadline. I remember watching viable businesses get hit with late fees simply because the receivables came in mid-month or came in late in the month. We as landlords wanted to work with them, but with no tools, we had no data, no infrastructure to really solve the problem. What RentFlow is building would have been a game changer for us. And here's what really struck me with the approach. This is commercial real estate's Moneyball moment. So if you read Michael Lewis's book, you know the story. Billy Beane and the Oakland A's were competing against teams three times their budget. So traditional scouts were going on gut feelings and subjective assessments. So Billy Bean and his team then asked, what if we actually looked at the data? What if we measured what actually predicts success? They found market inefficiencies everyone else was ignoring, and it completely changed baseball. And I think that's what RentFlow was doing here. The traditional way to assess tenant risk using credit scores or financial statements, tax returns, landlord references. It's like those old school baseball scouts. We're measuring things that are easy to measure, not actually what predicts payment behavior or payment timing or business revenue cycles. They're revealing that many small businesses aren't credit risk, they're cash flow timing risks. Completely different problem, completely different solution. So the landlords who are embracing this data-driven approach are going to have the same competitive advantage as the Oakland A's. So with that is going to come better tenant retention, more predictable rent collection, healthier portfolios, all from making decisions based on actual patterns rather than outdated proxies. We need to stop thinking about rent flexibility as a concession. It's a tool used intelligently with the right data can actually reduce your risks and improve your returns. The rigid monthly rent cycle made sense in 1950. It doesn't make sense for how small businesses operate in 2025. RentFlow is fixing that. And just like that, Moneyball changed baseball, and this data-driven approach to tenant-landlord relationships has a potential to change commercial real estate. That's all the time we have for today. Huge thanks to Alix Maurin and Joseph Thalinjan, co-founders of RentFlow. If you enjoyed this episode, please subscribe, rate, and review wherever you get your podcasts. If you have any questions, if you want us to answer on air, you can email us at info@creunplugged.com, or you can reach us at our website, www.creunplugged.com. See you next time, and until then, keep your conversations real and unplugged. Can I just redo the outro again? My kids are screaming. All right. That's all the time we have for today. Thank you so much to Alix Maurin and Joseph Thalinjan, co-founders of RentFlow. If you like what you hear, please subscribe, rate, and review wherever you get your podcasts. If you have any questions that you want us to answer on air, you could reach us at info@creunplugged.com or reach us at our website at creunplugged.com. Until then, keep your conversations real and unplugged. I know I messed that up. I got to do it again. Messed that one part up. Okay. Okay. That's all the time we have for today. I want to give a huge thanks to our guests. Give me a second. That's all the time we have today. Huge thanks again to Alix Maurin and Joseph Thalinjan, co-founders at RentFlow. If you enjoyed this episode, please subscribe, rate, or review wherever you get your podcasts. If you have any questions or you want us to answer any... Sorry, man. I don't know why I keep messing this up. Give me a sec. Okay. That's all the time we have for today. Thank you so much to Alix Maurin and Joseph Thalinjan. I think that's okay. Let me redo that. Thalinjan. Okay. That's all the time we have for today. Huge thanks to Alix Maurin and Joseph Thalinjan, co-founders at RentFlow. If you enjoyed this episode, please subscribe, rate, and review wherever you get your episodes. If you want us to answer any questions on air, you could reach us at info@creunplugged.com, or you could reach us at our website at creunplugged.com. Thank you so much for listening. See you next time. And until then, keep your conversations real and unplugged.